S&P 500 Index Analysis, Indecisive Week Amid Economic Concerns. In the next several minutes, we will analyze the recent performance of the S&P 500 Index, SPX, and discuss the key factors influencing the market. Despite a bullish week, concerns about the economy and inflation have raised doubts about the future direction of the market. We will also explore the long-term strategy for investors and provide a conclusion based on the analysis. Last week's performance. The previous week saw the S&P 500 index experience a sell-off due to fears of a potential conflict in the Middle East and concerns about the economy not slowing down enough to prompt the Federal Reserve to cut interest rates. However, the market rebounded during the current week, with the SPX adding 2.67%. Despite this recovery, the index remained within the previous week's trading range, resulting in an inside week that is considered indecisive. Conservative strategy. The conservative S&P 500 strategy aims to protect investors from bear markets by enduring short-term declines without triggering sell signals. This long-term strategy is based on chart analysis and does not make changes based on emotions or news events. It allows for market fluctuations without attempting to time every small up and down movement. Currently, the strategy suggests a bullish position in the RIDEX S&P 500 Nova Fund, RYNVX, or other S&P 500 index funds or ETFs. Current chart analysis. The recent week saw the SPX, NASDAQ 100 Index, NDX, and Russell 2000 Small Cap ETF, IWM, all experience inside weeks, indicating indecisiveness in the market. Although the SPX had a bullish week, the losses from the previous week were greater. The Gross Domestic Product, GDP, report for the first quarter showed slower than expected growth and higher than expected inflation, raising concerns about a potential stagflation-type environment. This combination of elevated inflation and slowing economic growth is challenging for Federal Reserve policymakers, as it may require rate hikes when the economy is already weakening. Troubling economic news. The GDP report revealed slower growth and higher inflation than anticipated, dashing hopes of a Fed rate cut in the coming months. The PCE Price Index and Core PCE Index, the Federal Reserve's preferred measure of inflation, both rose at a faster pace than the previous quarter. Additionally, high mortgage rates and prices have made it difficult for many homebuyers to afford a house, leading to a record median monthly housing payment. Conclusion. Despite a 2.67% gain in the SPX, the index remains below its 50-day average line for the first time since October 2023. Fib numbers suggest a severe correction could take the SPX down to the 61.8% support level at SPX 4549. However, this is a technical level to watch in case of a severe correction and does not necessarily have to occur. Economic reports released during the week, such as the decline in the S&P Global U.S. Composite PMI and the increase in new single-family house sales, provide mixed signals about the state of the economy. Based on the analysis, the current position in the SPX for the conservative strategy is bearish, while aggressive traders are advised to be in cash, money market funds.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.